Good morning, Richard.
Morning, and thank you very much, James.
So,
Um,
as usual, do you want to sort of just introduce CNC income and growth, please, and or the strategy, and I'll let you talk for a bit, and then we'll take some questions.
okay, great, thank you. Yes, a lot of excitement around Japan at the moment. As people are probably aware, the Nikkei exceeded the level that it hit in late '89, the peak of at the end of '89. And this is generating a lot of comment, a lot of excitement. We think it's somewhat irrelevant, partly due to the index structure and the changing constituents in that index. And we much prefer to look at it the way that you see here, and that's Topix total return. And you can see from this chart that the market is more than 50% higher than it was at the peak. But even that in itself it doesn't tell the whole picture. What we'd rather focus on is the fact that certainly for the last 10 years, since 2012, Japan has been a very, very attractive place to invest on a total return basis. That's both capital return and direct return to shareholders through dividends. And that really reflects the strategy that we feel is appropriate for Japan, and one that we have followed since we launched this strategy in early 2013. And that is very visible, I think, on the next slide. The way we approach investing is to look at cash flow and look at how companies are using their cash flow. And the chart on the left-hand side shows that during Japan's economic miracle, the bubble period, and even the lost decade of the 90s, Japanese companies were basically reinvesting all of the cash that they generated. However, quite notably, as those two lines diverge, there's been an alternative use of cash flow, and in subsequent years. If we look at maybe the first half of that, there was definitely requirement to repair balance sheets. So the balance sheet recession of Japan was very, very evident. You can see more recently, and very importantly, that cash flow is now being used far more productively. Companies are now investing to grow and complementing that growth, as you can see very clearly on the right-hand side, with returns to shareholders. And that has created a very, very different environment for people to consider investing in Japan. The second component of this, and the very important thing for people to consider, I think, is that it wasn't until 2010, 2011 that we felt confident in saying that the bubble period premium ratings that Japan had traded on had finally derated, and that the valuation opportunity in Japan was becoming more attractive. So effectively, we look at Japan now from around about 2012, 2013 as a ground zero. And from there, returns have been very, very strong. What we're looking for on the next slide, I think, is also worth reiterating. We feel that to invest for the long term in Japan, you need to identify companies that are or have structural growth opportunities. And that we feel there are many of those. We seek to identify companies who have some of the characteristics that are highlighted by that previous slide. So very, very strong balance sheets, stable cash flow, and they're able to use that cash flow to reinvest for their growth opportunities that they identify. Companies have very strong management, and that's something that we consider to be very, very important. And within that, an understanding of the role of minority shareholders, and companies, therefore, that are able to sort of complement the growth that they're generating on a fundamental business basis with an increasing return to shareholders through a steady and progressive dividend. Really, the opportunities in Japan are very, very exciting. We highlight the corporate governance code reforms. Really, what we're hearing and speaking about now is the culmination of more than 10 years of reform and change. Stewardship Code, Corporate Governance Code, introduced in 2014, 2015, have really been the foundations of the improvements that we're seeing in the return profile of Japanese companies. And has encouraged other interested parties like the Tokyo Stock Exchange to announce initiatives all aimed at improving understanding of concepts such as cost of capital and improving corporate value. And it hasn't finished. There are a number of other reforms proposed in the coming year, and we see this as a steadily growing bedrock to the strong returns that we're seeing. Maybe if I jump to slide 16, just on this first slide here, sorry, slide 8. Valuations are very attractive compared to Japan's history, longer term history, but also in terms of their shorter term history. So even though the market did perform very well in 2023, valuations are still in line with the measures that we've seen since the introduction of Abenomics. So we believe there's still a very, very long way to go. And our excitement is coming from these two components. We call it the two-pronged strategy, and it really reflects what companies are doing. So on slide 9, the next slide, companies are looking to increase their corporate value through growth, so raising their price to earnings ratio, and raising their value through more efficient management. So that includes business restructuring and capital management. And we maybe go into some of these in more detail, some of the questions maybe. But I think on the right-hand side, this steadily improving capital management and business restructuring is something that we've been able to highlight consistently over the last 10 years. What we're now finding more exciting is the growth opportunities that are emerging in Japan. Firstly, as it shifts from deflation, and we believe the government is finally about to announce an end to deflation 23 years after it was first officially recognized. And that's creating a very different environment. And also the benefits that Japan is seeing from the geopolitical fallout, which are creating very, very exciting opportunities for Japanese companies. So maybe I should leave it there. We do feel that the opportunities are now very exciting. The opportunities now, in many ways, are more exciting than when we first identified this strategy in 2013.
Great, thank you. There's nothing in the question list here yet, but I'm sure people will be typing away as we speak. So let's just go back, if we don't mind. Can you just talk about these things that you've highlighted in the red box here? So what might be coming in terms of corporate governance, please?
Yes, yeah, thank you. Yeah, well, pension fund reform first. So this is focused primarily on sort of private corporate pension funds. And it seems strange, or almost unbelievable actually, that there is no accountability, no requirement, no requirement for transparency, no requirement for corporate pension funds to disclose returns. That is about to change. That's what we see as pension fund reform, and this having a very interested pension fund industry, focusing greater pressures on companies to conform to all of the initiatives that we've highlighted here. So although there are already many interested parties putting pressures on corporate managers in Japan, we will now get corporate pension fund managers as well, giving their expressing their requirements to corporate managers. So the trend is very clear. Requirements of companies and company management to give greater recognition to the requirements of minority shareholders is very much very clear already, but we're now getting additional impetus to that. In terms of the FSA Business Improvement Order, that was specifically to the insurance industry, and it was a wake-up call to that industry to accelerate their unwinding of cross-shareholdings. That's very important. It's obviously something that anyone who's looked at Japan will be familiar with, but it's a legacy of the bubble period where companies built relationships with each other and took fairly significant stakes in each other's company. That has slowly been unwinding. but it still inhibits a lot of business practice and inhibits transparency in Japan. And the FSA recently highlighted the issue and raised the importance of an acceleration of that unwind, particularly to the insurance industry. And just as an indication of its importance, one of the sell-side research houses did an exercise where they basically assumed that all of the cross-shareholding unwind in Japan was used to buy back shares. And if that did happen, and that's the direction of travel, then the return on equity of the market rise from around roughly 9% to 12.5%, and that would equate to the market maybe trading on a valuation of 2 times. So at 12.5 times ROE, you'd be looking at a PBR based on correlations of around about 2 times from the current level of 1.5%. So, very, very significant upside just purely from an elimination of this capital inefficiency that exists in the market. So that in itself is very exciting. And then also I mentioned here the improved parent subsidiary governance initiative. Again, anyone who's maybe looked at Japan in the past will be aware that there are a lot of listed subsidiaries of larger companies, and this has created complications for minority shareholders. So there is a goal really to improve the clarity of management, improve the transparency, and improve the recognition of shareholders and the fair treatment of shareholders in probably what accounts for a quarter of the market. So about 25% of companies in Japan would probably fall under a parent subsidiary or an affiliate relationship with another listed party.
Okay. So yeah, definitely there's loads more then, really. I mean, to what extent is the performance of the stock market still linked to the performance of the economy, do you think? Because there's a question around that here.
Yeah. I mean, I think with most stock markets, there are clearly correlations with the underlying domestic economy. There are companies in the market that are purely domestically focused. But actually, if you look at the structure of the Japanese equity market, it doesn't truly reflect the structure of the economy. The exposure to exporters, for example, is much greater in the index and in the stock market than it is in the economy in general. And that is probably something that people are familiar with maybe in the UK. So the domestic economy is important. But we've seen, we can see here actually from the performance of the market over the last 10 years, even though the domestic economy has been one of the slower growing economies of the world, actually the equity market has performed very, very strongly. And I think that's a very, very important consideration.
Now, obviously, this chart is in yen.
Yes.
And the yen hasn't been the strongest of currencies. So what do you think the outlook is for the currency and how will that affect the portfolio, do you think?
Yeah, I mean, the currency has weakened. We're currently at levels comparable with the weakest level it's been over the last 3 years. But our expectation is certainly over a more reasonable time frame than a matter of a few weeks or months that actually the yen will strengthen. The reason it has been as weak as it has is really to do with the relative monetary policy between Japan, which has remained very easy, and tightening monetary policy in other parts of the world. But we do seem to be at a juncture now where the current governor of the Bank of Japan is very keen to begin to normalize monetary policy in Japan, and there's an increasing expectation actually that there might be an adjustment at the monetary policy meeting which began today. And equally, on the other side of that discussion is the possibility that maybe the tight monetary or tightening monetary policy in the US may begin to reverse. So our expectation is from here that we will see at some point some fair appreciation of the yen, and that in itself, I think, is an attractive makes Japan an attractive entry point at this point in time.
You've got some sort of themes here with the portfolio, and obviously this is organised into regional, global, domestic. To what extent is a kind of weak yen been driving the performance of some of the more globally focused companies?
Yeah. I mean, this actually chart is somewhere an answer to your earlier question, really, about the opportunities and the growth that exists in Japan that maybe isn't solely reliant on the domestic market. But yes, I mean, the currency does have an impact. I mean, interestingly, if you look at the structure of exports, they're very, very different now to what they were, and the trade situation in Japan is very different from what it was in the 80s and 90s. And the reason for that is a lot of companies have spent years building infrastructure, manufacturing facilities overseas. And so the direct impact of currency strengthening is much less than it's been historically, and therefore, or equally, the impact of currency weakening has been much less. I would say that certainly, if you look at exports, around about 80% of exports from Japan are auto or auto part related, and that industry will be affected by currency movements. But generally, most companies are looking to offer or manage the risk through business management, and ultimately, therefore, the currency risk is very, very low in their operating businesses. The reason for this chart really is, as picking up on that earlier question, is to identify where companies do see growth. And one thing that we quite often say is the Japanese government have been very, very good at highlighting the fact that the domestic demographic profile, will create a challenge to companies going forward. And even as far back as when I started my career in Japan in '97, this was the case. They were telling people that their demographic profile would ultimately see a decline in the population numbers. In reality, that didn't occur until around about 2017. So for a good 20 years or more, they've been telling people that that's the case, and that's given companies significant time to begin to address this. And some companies have done that already very, very successfully. So we've highlighted a few companies on the right-hand side that are global companies that have strong market shares, top market shares in their particular fields. Shin-Etsu Chemicals, the world's largest manufacturer of silicon wafer. That's Tokyo Electron's world leading semiconductor production equipment manufacturer. These are truly global, internationally recognized companies. Shoei is a much, much smaller company. It's a leading manufacturer of premium motorcycle helmets. But again, it has a very strong global presence. For many others, the opportunity might actually be more regional. And despite the fact that the Japanese population might be in decline, also the population in and around the region is still growing very strongly. And there are many, many companies who are able to benefit from the strong reputation that Japan has for both service quality and product quality, to benefit from the growing demand that exists within the region. And then finally, despite the profile within Japan, there are still opportunities for companies to grow within that. So, healthcare might be one area, but also areas such as e-commerce, and the two companies mentioned there are companies that have used the internet to establish very, very strong market positions.
What I don't know on there that's mentioned in the questions here is SocioNext. Do you explain a bit about what it does and what the attractions of it is, please?
Yes. SocioNext is a fairly recent listing in Japan, and it is a manufacturer of semiconductor chips, application-specific chips, which are a key component in a number of very, very important products, including potential within AI. But SocioNext has a very, very interesting history, and I think when we think about some of the things going on in Japan, this is probably a very, very good example. Socionext was formed out of business divisions out of from two of Japan's leading industrial companies, Fujitsu and Panasonic. And rather than sort of compete and maybe develop different technologies, these two companies were merged a number of years ago. And this company then came to market in August 2022. And it came to the market because of its parentage, a very, very strong balance sheet. It came to the market with a very strong potential growth profile, very strong and competent management, and also because of that, the strength of its business, the ability to, from day one, offer a very, very attractive dividend payment or dividend yield at listing price. So the stock fitted this strategy very, very well.
Okay, cool. You've got a slide here on the dividends. What's the portfolio yield?
The trust yields are just below 3%.
Yeah.
But
so it's generally, are you investing to sort of natural income, so companies that are paying dividends?
Yes, we are. We consider investment on a total return basis. So we're looking for companies we believe will grow and generate capital return, but are able to complement that growth with this compounding benefit of delivering dividends. And we feel actually the potential in Japan for delivery of dividends and consistently growing dividends is much more exciting now than it was even when we first identified this as an opportunity in 2013. And that was really the purpose of these two particular charts.
Yeah.
So even though companies have been very generous and been distributing consistently to shareholders over the last 10 years, actually the amount of cash that has been accumulated on balance sheets over that 10-year period has increased. And the number of companies that are in that very, very strong position of having surplus funds on their balance sheet has increased. So that chart on the left-hand side shows that almost 60% of companies in Japan now have net cash. That figure was probably around about was roughly 40% 10 years ago. So the potential universe of investment opportunities has increased as a result. And on the right-hand side, payout ratio, or we could look at it slightly differently and call it dividend cover, remains very, very healthy. And that's why during the years of the pandemic, actually the dividend profile in Japan was far more robust than it was in many other markets, particularly Europe and the UK.
So are you expecting kind of decent dividend growth from your portfolios going forward then?
Yeah, yes, we are. Yes, and it had a fairly consistent record sort of prior to the years that covered the pandemic. But what we've been particularly encouraged by is the speed at which companies are returning to that strong intent to deliver to shareholders, and that's only accelerated by these initiatives that I mentioned, particularly the Tokyo Stock Exchange recently requiring companies to focus much more on cost of capital, and ultimately corporate value. And there are two specific examples that I did on the next slide, where companies have taken what the Tokyo Stock Exchange has asked for, so its action to implement management that is conscious of cost of capital and share price, reviewed their business, reviewed their investment requirements, and as a result of that discussion or that analysis, have determined that actually their payout ratio it must be higher, so that they're not reducing their capital efficiency. And these are two very interesting examples. Japan Securities Finance, which is a company that's established in the 1920s. It currently trades at a price to book value of less than 1, and it is determined because its capex requirements are relatively limited currently, that its dividend payout ratio will rise further from 50 to 70%. Zozo is a much newer company. It was established about 20 years ago. The starting point is very different. Its price to book value is around about 4.5 times, but equally that the analysis and review of what has been asked has led it to increase its payout ratio. Similarly here from 50% to 70%. But this is all to the benefit of us as minority shareholders.
Mhm. That's great. I mean, and are you bothered whether, I mean, I know obviously there's a requirement to reduce the yield, but are you really bothered whether they pay out dividends or whether they buy back shares?
We'd much rather companies pay dividend and on a consistent basis. Now there are circumstances where we do encourage companies to buy back shares, particularly where we believe it will increase capital efficiency. So as a fairly sort of crude measure, companies trading with a price to book value of less than 1, for example, can improve their capital efficiency by buying back shares. We tend to encourage that. But generally, we like the approach that seems to have been accepted in Japan, that buyback should take into consideration factors such as valuation and levels of liquidity, rather than just being a sort of systematic program each and every year.
Okay, fair enough. You've got a slide here on your process. I just wanted to pick this up. The one question I had is, do you ever buy things that don't have a yield because you think they might declare a dividend in the future, for example?
We have the capacity to do that. So the way we structure the portfolio is to focus primarily on companies that have all the characteristics that I've mentioned, and have a high weighting in that particular category, and we call that dividend growth. But we do have the capacity to identify companies that maybe are at the point of change, where historic analysis would show that maybe they haven't paid dividends before. But if we believe that the situation is changing, obviously the next 5 years are far more important than the historic 5-year track record, and therefore we could. I would say up to this point in time, we have never invested in a company that isn't paying a dividend. We've invested in companies whose dividend yield is lower than the market, but not in a company where the dividend has been 0.
Okay, fair enough. And then the other thing that I think is interesting, because it differentiates what you're doing from funds like AVI Japan and Nippon Active Value, is this business about the good management and avoiding things with poor corporate governance. So you're never buying stuff that you think this is a good company, but it's got the wrong managers, and if only we vote against it and change this, we can get more value out of it. That's not your approach, is it?
No, we're certainly not activists. We spend a lot of time meeting company management, and I would say we spend a lot of time encouraging companies to behave in the way that we think is appropriate. And when we believe we see that change, then that's when we might establish a position. No, I do think it's very interesting, actually very exciting, that there are different types of investors now looking at Japan in different ways. But our preference really is to invest in the companies that are doing, high quality companies that are doing the things that we want and benefit from the compounding impact of that. Mm-hmm. The profile, I'm sure the returns profile of companies that you mentioned that are doing things differently will be very, very different to ours.
Yeah, exactly. Is it wrong to pigeonhole this as a sort of value style? I mean, I know dividend income is a sort of natural thing, an indicator of value, but do you end up buying quite sort of fast growing companies that are paying dividends as well?
Yeah, I mean, I think that's the unique opportunity that exists in Japan at the moment, is that, and we spend a lot of time trying to certainly emphasizing that even though we have income in the name of the strategy, it's not a value fund. So I realize in other markets of the world, income and value are quite often closely associated. We don't think that's the case in Japan, and would maybe love to rename the strategy Growth with Income, because there are so many opportunities that we find of these high quality companies that some are of whom I've mentioned earlier, that are very clearly growth companies, but do have the capacity to continue to distribute to shareholders, partly because this is still a relatively new fledgling concept in Japan, return to shareholders. Although we've been talking about for 10 years, there are many companies who've built up resources, cash balances for decades before that. And this is now starting to come back and to shareholders because attitudes are changing. So I think it's a very, very exciting opportunity in Japan for that reason, that we can find companies with the characteristics that people would look for in terms of distribution, direct distribution, but they are companies that on an underlying basis are very clearly growing.
Cool. Okay. Just to sort of knock off a few things, because there seems to be maybe some confusion in the questions. So firstly, you're only investing in listed companies, is that true?
Yes, that's true. Yeah, only listed companies.
Yeah. And you are buying companies, you're never buying like index ETFs or anything like that?
No, we don't. No. We have held real estate investment trusts in the past.
Okay.
But we currently don't own any at all.
Fair enough. And it's very much a Japanese focused fund. You wouldn't buy anything outside Japan?
No, it's Japanese assets only.
Cool. Right. That's good. Obviously, that's not the sum out. That's good. And then can you say a little bit about what's been driving the performance of your portfolios recently? Like what is it all on individual stock basis, or is there any kind of thematic thing going on?
Well, certainly the portfolio is built very much on a bottom-up basis, so identifying the companies that we believe have the characteristics that we're looking for, rather than being thematic as such. But obviously, as you put portfolios together, quite often from that bottom-up analysis, you can identify sort of themes that run through. Most important for us is this corporate governance and return to shareholders, and I think there is this increasing recognition of what is taking place in Japan. This sort of evolution, for some, I sense it might seem like a revolution, but actually it's an evolution. This started at least 10 years ago, and the benefits I think are now are visible. And these further initiatives are really sort of highlighting that and accelerating that. In terms of the sectors that are able to demonstrate these characteristics, then if we look at the attribution profile, we certainly benefited from some individual holdings and participation, and the participation in the IPO of Socionext has been a very good example of that. But also the exposure we've had for quite a consistent time, actually, in some of the financial companies that I think have been right at the forefront of the change that we're seeing in Japan. And this has been highlighted actually by a very well-known and renowned investor from Berkshire Hathaway, who in the recent letter, I think, gave spoke about Japan in quite glowing terms. And we are able to find the characteristics that are referred to in that letter in quite a number of sectors. And some of those in financial sectors, for example, banks, insurance companies have been very, very strong performers in recent years. Yeah.
So really quite rosy outlook then. I think we might wrap up there anyway. That's okay, Richard.
Yes. Yeah. Well, thank you very much.
Thank you very much. That's really interesting, and it's obviously you've been doing quite well, and long may it continue. We'll get you back again in a year or so and see how things progress from there. But thanks very much for today.
Yeah, thanks very much, James. Thank you.
Thank you. So we'll be back next week talking to Oakley Capital, and then the week after is the first of our panel discussions. So we've got James Hart from Wootan, Nish Patel from CT Global Small Companies, and Jonathan Brown from Musco UK Small Companies. And we're just looking at the impact on markets of what we hope is been the peak of interest rates, and whether that is now providing some kind of a fair wind to what happens in the markets going forward. Then we've got a break for Easter, and then we'll be back. And as I said, we've got a full lineup of people going through all the way through to the summer now. So thank you very much for your time today, and have a good week. I shall see you next Friday.